an enormous number of the algorithms each day. I mean, most of the algorithmic activity you see is market makers, hedging positions. The gamma scalpers, the gamma hedgers hedging positions. A lot of the HFTs, that's exactly what they are. They're not just all prop desk HFTs. The vast majority of in fact, none of the early HFTs were prop desk HFTs. They were just execution HFTs. And then the hedger started to use them because the hedger was the algorithms are far more efficient at hedging properly the dollar valuations rather than trying to calculate it all out. And it was only in the latter stages that the prop desk started to get an idea that HFTs could be valuable, knowing what the other HFTs were doing. And then they started to do all the nonsense, the games and the envelope stuffing and all that kind of stuff, quote stuffing stuff. Anyway, so when we have a chart like this, remember the idea is that this here, that there is the profit. Now, obviously I've scaled this. These are all to the right scale, so the numbers that we come up with are the right scale in numbers. That's how much the dealer earns if the price stays at the maximum gain, correct? That's how much money the dealer earns, because that's the price of the option. That's the total price of a put option and a call option at the money strike. So that's how much they earn if the price closes at the maximum gain price level. So we take that box down and we add up all the positive boxes and we take away all the negative boxes, assuming they didn't hedge or they did hedge. We can take a look at whether they did or they didn't based on how the volatility pricing comes in and make a decision on that. Well, you can see that this closed off the bottom edge, didn't it? So in other words, that gain was reduced by that amount, wasn't it? Agreed? The gain was reduced by that amount. So we can take that amount off that box and basically come up with a brand new box valuation. In other words, that was the market maker's profit on the day from the bottom to the black line to the black line. That was the market maker's profit. As we go into the next day, we can see exactly the same type of storyline. There's the total profit there, yeah? And again, we can take that, we can take that total profit there, and we can bring that box and add it to the previous box for the week's profit. There it is there. And you can see that they started to hedge, but they kind of started to hedge quite late in the process here, didn't they? You can see that they started to hedge quite late in the process. So they kind of moved the box as it broke back below this threshold. So they probably gave back a fair amount of money because of the speed of that move. So we'll assume they gave back a chunk of that money. So that's probably how much of that trade they gave back. Simply because the volatility was not telling us anything else. So based on that, you can see that the actual gain that day actually was quite small, probably. But it's still a net profit. Remember, this line from the bottom to the current black line here is what their net profit is during the course of this week so far. The next day, you can see that they made this total profit here. And we bring that box into the line again, and we put it on top of the previous line just there as we did the last time. And they almost made a maximum gain on this, and they could have double alphaed that. You can see that the volatility was incredibly bullish off the lows, so they could have bought some nice business there to double their profit. Now, this is assuming they do nothing of the sort. This is assuming they're actually very, very, very passive hedgers, very passive hedgers. So they gave back some of that money. That's how much money they gave back, of course. Yeah. So that's how much money they gave back. So we can obviously take that off the total there. And now we've got the total value for the 3 days is now this level here. Doing pretty good, right? Doing pretty good. We talked about this day here. They never got any profit on this one. They actually ended up with a loss on this one because obviously the total profit was this, correct? So that was their total profit. We put it on the black line. That was their total profit. However, they ended up losing as the price broke out of that. They gave away all their profits, and we suggested they probably gave back that amount of money. So if we take that off the high of the black line, of course, that puts a new black line down here. So they lost money that day. But this is still their week's profit here for 4 days. And then this day here, we can see that they had a reasonably solid day, didn't they? Very good day. maximum profit there. We put that onto the black line, which is now at the lower ledge, which is there. That's the total profit, and they gave back very, very little of it. They gave back that amount of money there. That's all they gave back. Tiny little amount of money. Can't even make it small enough that this will change to. There it goes. So they gave back that amount of money there, and that's how much money they made for the week. So there's their profit and loss. From there to there, that's their total profit and loss for the week. So you can see it was an incredibly profitable week, even though they actually slipped a gap on one of their days and they lost money that day. If they were relatively active in their hedging, they did exceptionally well. If they were very active in their hedging, they could have done massively better. Because if you think about it, when the market opens gap down here, they could have doubled down on their bets, right? Because they were in serious trouble here. At that point, they were in serious trouble. So they could have doubled down on their bets at that point. And obviously, on the basis that they're doubling down on their bets, you could obviously start thinking about how they could hedge out that exposure. They could have bought a lot of stock in there, and that they could have added that to their overall profitability. And that would obviously be something you'd have been able to look at. But you see that it is a profitable business model. That's why somebody was mentioning it, you know, how profitable the business model is for these guys. It's a very profitable business model, but it's not 100% profitable all the time on these gap type trades. And that's why we have the problem of the runaway markets. Because you can see that on a day like this, these guys are in real trouble. Yeah, these guys are in real trouble this day, but they're not actually in real trouble, are they? Because the price did stay at their maximum gain level there, inside their their profit zone there for a few minutes at least. So obviously, based on the reads, you would have recognized that they were in a hurry to sell, and if they're in a hurry to sell, that's what causes a market collapse like this. That's what causes these market collapses. Because what will happen is that sell will then bring in, for example, a delta from a day before or a week before or even a month before. A big delta flips, and there's some big put options resting there that previously were worth nothing. All of a sudden, those massive put options suddenly become worth a lot of money, and they have to sell even more, and the price accelerates to the downside, which opens the door to potentially another cascading run through stops. And we get a very, very big slipping marketplace, which obviously ends up losing an absolute fortune and everybody's panicking. Well, that is a real, genuine panic that day. You know, that is a genuine panic. And if the bobbleheads were shouting, careful, 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 you would definitely pay attention to that, because that is a genuine panic, right? That day there is a worrying day. This day is not worrying in the slightest. Not worrying in the slightest. This day, even though this day gapped down the way it did, no worry in the slightest, was it? There was no worry that day. And there was no worry on this day. There was major concern on this day. Do you see how we can make those reads ourselves? We don't need the bobbleheads to help us. We make those reads ourselves. When it's time to panic, we'll panic, right? We'll get short. And we'll make a lot of money. But when we know that they're wrong, fundamentally flawed in what they're saying, we can take massive advantage of that, because there's enough diddies that will listen to them, right? There's enough idiots that will actually pay attention to what they're saying and think it's true and join in with a bit of business. There was a beautiful buy trade there on oil, by the way, guys. Did anybody buy for the 75 squeeze? Did you see the sellers getting trapped just ahead of 75? Did you see them? I just bought some there at 74.95. And we got a brilliant little buy-side squeeze through to 75.25. Another 30 ticks worth of buy-side beautifulness, guys. Beautiful, 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 and a little bit of beautiful. I told you to mark these traps. I told you to be actively marking the traps, and guess what you do when you actively mark a trap, guys? You trade against them. Preferably, if you also happen to be on the strong hand. So is it better to find trapped buyers that are strong? No. It's preferable to try and find trapped buyers that are weak, correct? Because they've got nowhere to go. Is it preferable to find strong sellers that are trapped? No, it's preferable to find weak sellers that are trapped. You understand? So when we put those two pieces of the jigsaw puzzle together, we have the intern's business plan. We have every floor trader's business plan. We have the HFT's business plan. Do you understand? Make sure you do understand and you just don't become a bobblehead. Just nod along with the bobbleheads, guys. Make sure you properly understand that as a storyline because it's incredibly important.